I'm Alex Mozet, and welcome to Winner Take All, where we talk about the constant battle between large tech monopolies and traditional incumbents. I'm excited that we're joined live from beautiful sunny Florida with Sean Ammirati, who, amongst other things, you have a podcast going called Agile Giants. You've got a VC firm that you're a partner of. You do startup incubation stuff with Carnegie Mellon. I don't know, you probably got a few other things going on, but great to have you on the show, Sean. Why don't you tell us a little bit about what keeps you busy these days, and we'll jump on in.
Yeah, that's a pretty good summary. So, I mean, I think of my time as being split along different dimensions, all with the same goal of helping each of these different touch points be more entrepreneurial. So some of that entrepreneurship is what I would call traditional entrepreneurship, brand new de novo companies, a couple of people coming together with the goal of it becoming a large startup. Some of it is what I call corporate startups, which are small teams within large companies that hope to be large teams within large companies someday. And so, along both those dimensions, I have activities at Carnegie Mellon and around investing and venture activities to kind of support that. My background was very much a traditional entrepreneur, and have really only over the last 3 or 4 years become really interested in this corporate entrepreneurship space.
You started a business, you raised a few $1 million, you were LinkedIn's first acquisition many years ago. Hopefully they bought you with some stock and you held on to that stock. And then you went on to read, write, web, say that 3 times fast.
That's right.
As COO. So yeah, you exactly as you're saying, you have that classic entrepreneur upbringing, and now you're kind of seeing it in a few different facets, right?
That's right.
I mean, when you think about the startup ecosystem, right, and like all these different channels, how would you try and kind of break down, the different things that you're doing, right? I mean, you got VC, you got kind of like incubator stuff going on. You've got a few different ways to say, hey, how can you support that startup landscape? How do you view it? And what are you most excited about within it?
Yeah, that's a great question. So similar to you, in 2016, I wrote a book called The Science of Growth. And when that book came out, I was honestly very dogmatic about, look, all great startups and all great entrepreneurship starts with 2 or 3 people in a proverbial garage somewhere that, literally or sort of metaphorically, and that's how you do innovation. And, I really believe strongly that the key to making the world better was to get more people to go be entrepreneurs in that vein of entrepreneurship. But something interesting happened with the book, which is, and I'm guessing with Modern Monopolies, you found the same thing. The book did very well with that target audience. So, it sold tens of thousands of copies via accelerators and things like that. But the reason the book has been such a bestseller is, in addition to all those sales, companies came along and started buying the book in bulk. And it turns out that when a Fortune 500 company buys a book, they don't buy like 5 copies like a startup does. They buy like 500 or 1,000 or in one case, 5,000 copies. And so, like all good entrepreneurs, I was like, well, let's go talk to our customers, the people who are buying these books. And it was kind of a nuanced way to get there because the publishing industry is kind of crazy. So there's a bunch of intermediaries, but we got through the intermediaries and started talking to them. And what I realized is all these companies are trying to rediscover their entrepreneurial roots, right? And the more time I spent with them, really over the last 3 years, every probably 6 months, I've become more intrigued with this corporate entrepreneurial activities in lots of different business models. I know you're kind of an expert on platforms, which I think is one really great business model transformation companies can go through. But more just if you were to level up and just think about this in general, right? I think what's interesting, and platforms are one good example of this, is actually there's a bunch of businesses that they actually make more sense to be created inside of a large company than as four people in the proverbial garage. And so as I think about this goal of making everybody an entrepreneur and solving all of these problems via entrepreneurship, I've become very interested in doing that in an area where not a lot of people are doing it today, which is these large, as you put it, incumbents, and them leveraging their incumbency advantage to build these startups.
So let's double click on that. There's a Fortune 100 company. I know the people at the kind of corporate innovation group there very well. They historically have had two buckets in this arm. One is a CVC, right? Traditional corporate venture capital arm. The other arm is an incubator, kind of like venture studio. Let's try and go build startups from scratch. Like GS Accelerate. Let's let people, come to us with ideas and start new businesses and all that kind of stuff. What they are on the verge of doing is a third arm, which is to say, hey, we have all of these assets locked up inside of our core business. If we could unlock or capture these assets and then go invest in this startup over here, not only can we bring capital to the startup, but we can help that startup solve for scale. This actually isn't a platform example. When you talk about platform startups, and many times scale can actually be more important than cash. But still, for any startup, scale is important in one way or another. But when you view kind of the tranches of how an enterprise can think about harnessing innovation and new business models, do you see a kind of like three buckets where you have the two traditional buckets and now there's kind of this third commingling of the two? Do you see it differently? How do you break it down?
Short answer is I think at the highest level, you have outside in and inside out innovation, right? So I would put the GS Accelerate or, Numo at PNC. Those are probably two really good fintech examples. But you have examples in healthcare and lots of other verticals as well. I would put those in the bucket of inside out innovation, right? That's taking internal teams and having them basically act like startups. And then I think corporate venture is a really good example of outside in innovation. What I think you're seeing though is that innovation leaders in general are realizing that they need to have a portfolio of activities under both of those buckets. And so to me, your thumbnail description of what you're talking about there would be a different approach to corporate venture from my perspective. Because, if you think about the venture ecosystem overall, right, it's evolved a lot in the last 10 years. And one of the things that's been intriguing to me, and we've had probably 10 or 11 CVCs on Agile Giants at this point, is I feel like corporate venture is about to go through a very similar evolution that the rest of the venture ecosystem did, kind of from 2006 to 2012, right? You saw these studios emerge, you saw accelerators emerge, you saw different kind of investment models. And I think up till about a year ago, most of the CVC activity fell into two buckets. It either fell into classic corporate venture, like the Intel Capital would probably be the kind of canonical example there, or partnering with a group like Techstars to do an accelerator. And there's pros and cons to both of those approaches. But if you think about all the different types of CVC, or all the different types of venture, that would be a pretty limited coverage of corporate venture activities. So just to give one example of this to make it more real, we've partnered with a group inside of Optum, which is part of United Healthcare. It's over $100 billion a year software business, which would make it one of the largest software companies in the world, except for it's part of United Healthcare, which is one of the 6 largest companies in the United States right now. So people don't often know about Optum. But we've partnered with Optum to create what we've called the Optum Startup Studio. And I think that's, again, similar to what you're talking about, where it's like, it's capital plus expertise plus unique assets and advantages that they can bring to bear. To me, like models like the Optimum Startup Studio or the Fortune 100 company that you're referencing, I think those will be as disruptive to corporate innovation venture activities, that sort of this sort of outside in innovation activities, as, for example, a company like Science was to the venture ecosystem, roughly a decade ago, or in your neck of the woods, BetaWorks was in the venture ecosystem.
If I was to kind of outline like two big gripes, or one gripe for each of those kind of traditional buckets, right? Where kind of classic CVC activity, I'm a big corporate, I write a check. But there really isn't as much strategic integration or delivery on, hey, we closed the deal. Now, maybe all of these synergies and integration opportunities were promised, but were they actually captured? And I think probably 9 times out of 10, the answer is no. So you have a feeling of a lot of these startups where they have been skeptical, and I'd say probably, many times rightly so, about the promise of, all these wonderful things that can be locked inside of the large corporate. That's on one side of like the CVC. On the other side, which is, hey, let's go build these startups inside of our mega behemoth enterprise. The gripe there is, well, it takes a long time to get to scale. And maybe the executives that felt really passionate about this thing, maybe they've moved on in their career. Maybe they got bored. Maybe they focus on the next shiny object. And how do you kind of stay relevant over a 5-year time horizon, which even getting to scale in 5 years would be a fantastic feat? How do you overcome these things? Yeah. Are these two things kind of leading to that door number 3, or what do you think?
So I think that they're leading to doors 3, 4, 5, and 6, if you will. I think you're going to see a lot more. You're going to see a lot better models. And it's not that those two models, by the way, are not good. I think they have a place, but I think they're overused. The sort of classic example is an overused, over duplicated playbook, if you will. But I think that the reason these really break down, and your sort of critiques of both, I think, are really pointing to the same failure, which is that most of these companies are copying the wrong things from entrepreneurship. So when I started this 3 years ago, again, pretty cynical at the time about corporate innovation, one of the questions I asked myself that actually really helped me reframe a lot of this is, well, let's look at what's similar and different between corporate startups and traditional startups, and at the highest level. And part of what I came to realize is that most companies didn't appreciate the similarities and differences, and then they borrowed the wrong things from traditional entrepreneurship because of that. So, for example, many of them have adopted a Shark Tank-like pitching model. Well, the reality is the way you fund corporate innovation is so different than how venture funds work. And I know this because I run a $50 million venture fund. The way they work is so different. It's a bad analog. I mean, leaving aside the point that venture looks very little like Shark Tank, which is kind of a whole separate point. But even if you ignore that detail for a moment, even if it was venture looks as much like Shark Tank as the sitcom or the drama ER looks like an actual emergency room, right? Like these are not good analogs for even what they are. But even if you ignore that for a moment, right? The point is, corporate venture is not like these. The way you finance and fund these things is completely different. You have one LP, you have a handful of funds. These are coming off of your capital. They're valued differently. Like you're putting people on just completely the wrong path. And I think what you're seeing a lot of these companies do is they're missing the ways that they're similar and the lessons they can learn and the collaborations that can happen because they're copying the wrong things from each other. And I think that leads down to some failure points in some of the door number 1 and door number 2 that's kind of well-trod ground over the last decade. And I think what you're going to see is a lot more interesting models over the next couple of years, especially as companies become more conscious of the sort of new realities we're all going to be living in. I think for most corporate innovation groups, they're going to come out of the next couple of months, and some of them are just going to go away because this is, it's going to be hard choices. But those who really lean in, I think they're going to tell you in 6 to 12 months, man, a crisis would have been a terrible thing to waste, and I'm glad I took advantage of this crisis to really reinvent how I do corporate innovation.
And maybe some of what you're getting at is how does the innovation or the funding of these startups or new initiatives integrate more tightly into the core business? Would you say that's kind of a common thread across your 3, 4, 5, 6 stores?
That's certainly one of them. I think another thing is that the reality is to be a viable thing inside Goldman Sachs for GS Accelerate means very different things than when a seed stage company comes and pitches my venture fund. We have different expectations. We have different strategic fit. And this is not Goldman Sachs. There is an industrial company that we are working with who put $40 million into one of their internal innovation ideas at a similar platform to GS Accelerate that they did it through, and then realized $40 million into this again, oh shoot, it turns out that there's no good business unit for this to live inside of. And even though it's been well received by the market, unfortunately, it's not big enough on its own, and it doesn't fit into any of these. So we've got to kind of try to now play catch up and get rid of it. And the reason they did that is the tools that they had borrowed. In their case, they had leaned very heavily on Alexander's business model canvas, which is a great tool for a traditional startup to say, is this a viable business model or not? But here's the problem with that canvas. It misses a bunch of questions like, is this a good business model for my company? Which is a very, very different question. And when you become very dependent on tools that were built for 3 people startups and train your people on those tools, you end up often with unforced errors. I mean, they could have diagnosed the thing that they realized $40 million in, $500,000 in. And think how different their return on their innovation activities for the next couple of years would be if they would have done that. There's certainly things you can take from the traditional startup playbook. It's a lot of the stuff that Steve and Eric have been pushing for a long time, this sort of early customer discovery and how you do that. There's a ton of stuff there that's really valuable, but you got to make sure you're copying the right stuff from these playbooks, not the wrong stuff.
I think the other thing there, which you're touching on, is organizationally, it seems like that initiative had a good amount of autonomy, which in general you would say, oh, you need autonomy. New startup initiatives, they need to be separate from the core. The core is going to stifle them. But if you had the CEO of the holding company or the CEO of one of the business units or the CEOs of the respective business units, I don't know how they're, how this company is structured. Pretty sure those CEOs would have been pretty vocal and said, yeah, this stuff sounds interesting, but I'm not going to use it. And then someone would have probably said, well, maybe we should look for other ideas, right? I mean, when you think about ownership and executive buy-in and sponsorship, does the CEO need to spend time in some way or another in these kinds of new business initiatives if they have a shot at being successful?
So I think the best practice is certainly for them to be involved. But I think that what you're touching on is important. It's what's the right engagement model. And so to me, here's again, copying the wrong things. So I think the right model there's a correct model for the corporate entrepreneurs themselves, the people leading these groups. And then there's a correct model for the people who are sponsoring this more at the portfolio level, the strategic level. The model for the people sponsoring this at the portfolio or strategic level is more like a board member, venture investor than it is like entrepreneur. And the challenge here is that venture is a learned via apprenticeship model, right? So most great early stage investors start as entrepreneurs themselves, and then there's kind of peer learning for those who are able to raise funds from each other, right? The problem is if you're the CEO of a Fortune 500 company, you've typically gone up the ranks through some other learning model. And now all of a sudden we're telling you, hey, you need to make sure that you're not disrupted, that your business is not disrupted, because if it is, buddy, like you're going to be the CEO who killed the golden goose of that 100+ year old company, right? And they're like, okay, great. Well, I'm really good at finance, so let me apply my finance, or I'm really good at sales. Let me apply that muscle to it. No, just like entrepreneurs who become VCs need to learn to operate different as a VC than as an entrepreneur. Executives who are going to sponsor these things, they need to learn how to operate differently than they did running a GM of a business unit, for example. And I think again, this is where we're not taking the right lessons from. There's real opportunities, I think, for learning to go both ways here, but I feel like we're just in the first innings of figuring that out right now.
I saw a report, something like, CVCs that report directly into the CEO have a large majority of their deals are shut down or something like that, right? And I think the report was trying to say, well, this is a bad thing, or probably not a good idea for CVC to report into the CEO. And I look at it differently, which is that, good, you got the no early. You're not wasting anyone's time. And if the CEO or that key executive in the organization isn't able to wrap their head around saying, hey, this is this new business model, maybe it does compete with our core business, right? But to be able to kind of look past that and see all the potential benefits in addition to potential short-term commoditization, and how do you make those trade-offs, right? I think there's just going to be these certain inevitable points of conflict. They're either going to come to a head now or in the future. To your point, culturally, how do you make sure you're having the executives involved and helping those executives embrace a different way of thinking? But you do need them to be a part of the process, just like you need the right, people at the helm of that CVC or that corporate innovation directive to help provide the balance. But if it is too kind of lopsided in either direction, then you're not going to have the right equilibrium, and this stuff really isn't going to work.
We've done some research on this at Carnegie Mellon, but we have not found anything conclusive yet on the correct org structure, reporting structure. So I'm personally not comfortable saying reporting into the CEO or a chief innovation officer or a director of R&D. Like, I'm not ready yet to say, like, to be prescriptive in that way, just because I feel like it's still an open question in my mind. I think there's good and bad examples of lots of different reporting structures. But I think the point that you're making that's absolutely correct is that ultimately, regardless of who that person's direct report is, the entire C-suite of the organization needs to be culturally bought in, understand the strategic objectives of it, and understand what the goals of CVC are. And frankly, same thing for the internal programs like GS Accelerate or Numo, as well as these sort of new hybrid models like the Optum Startup Studio or the Fortune 100 company that you were mentioning. This really is something that needs to live at the C-level, at the C-suite, if you will. But I think also those people need just a little bit of coaching to get through that. And so there's lots of different ways to get that. I think this is still things to be flushed out, but I think you're going to see a lot of education. I think this is a huge opportunity for, frankly, the right type of boutique consulting firms to help with this. I also think groups like Touchdown BC do a really nice job helping with this. There's a bunch of different answers to sort of solving for this, but I think you're posing exactly the right things for executives to ask themselves as they think through what the right strategy for their company is.
Love it. Well, Sean, thank you very much for joining us this morning. And to get more insights, tune in to Agile Giants, the podcast, available, everywhere. And I will talk to you again shortly.
All right. Thanks.
Hi, this is Alex from Winner Take All. Thanks for joining us. Hope you enjoyed the content. Feel free to leave a comment, ask us questions, and definitely make sure to join us on our next live stream.